We've had some great questions and conversations since initially discussing the buy, borrow, dive strategy last week. Today, we'll discuss SWORDX's suggestion about what a margin call is when referring to borrowing against securities. To reiterate, none of the content in this or any other post is advice. Any financial decisions made regarding purchases of and borrowing against real estate and equities should be considered very thoughtfully and carefully. To dive in, what are we talking about with regard to borrowing against investments? I'll clarify one point. Retirement accounts such as 401ks, 403bs, or IRAs should not, and in some cases cannot, be borrowed against. Borrowing against investments is usually referring to investments held in a taxable brokerage account. You may have investments in a taxable brokerage account at a firm like Fidelity or Vanguard. These securities, which may include stocks, bonds, or mutual funds, serve as collateral for the loan. Rather than selling the investments and incur capital gains taxes, one may choose to borrow against the assets, using the investment portfolio as collateral. The lender may allow 50 to 90% of the portfolio's value to be loaned. These amounts can vary based on factors like asset volatility and the lender's policies. The loan strategies used may include a securities-backed loan or a portfolio line of credit. Borrowing in this way facilitates tax-free access to cash since loan proceeds are not taxable income. You can maintain your investments and you can continue benefiting from their continued potential appreciation. If the appreciation rate of the underlying assets, the brokerage account, exceeds the loan's interest rate, the strategy can potentially amplify wealth accumulation. There can be other benefits as well, which we may explore in another post. Here are some reasons this strategy requires careful consideration. Substantial assets are required. If the value of the collateral declines, the lender may issue a margin call, requiring the borrower to provide more collateral or pay down the loan. If the borrower cannot meet the margin call, the lender can sell the collateral. Proper estate planning is crucial to ensure the transfer of assets and debt to heirs is managed. As with many investing strategies, there is risk of loss if asset values decline significantly. What are your thoughts on this?